Most people investing in ETFs over stocks often assume they're safer and better long-term investments, but some Canadian ETFs have been losing money for investors this past decade, and even more have closed down. In this video, I'll briefly show you the worst performing Canadian ETFs this decade, what they're invested in exactly so you can avoid them, and how much your investment would have lost over this time period. After, I'll quickly show you a list of Canadian ETFs that have closed down and some simple tips on how to avoid them so you don't put your money at risk. You'll be surprised that over the last decade, roughly 1,000 ETFs have closed down around the world. That compares to roughly 7,000 ETFs that are still operating. Statistically, there are 200 new ETFs every year, and 25% of ETFs have closed since 2014, so the odds aren't very good. Here are some of the largest ETF issuers and how many funds they've launched and closed down until the end of 2019. It's quite shocking that the number of closures are fairly large, around 20 to 30%, and big issuers aren't immune to shutdowns. Before we start, it's worth mentioning that a majority of Canada's worst performing ETFs are in the energy industry. Let me quickly tell you what has happened in the world of energy. The industry works by movements in supply and demand for oil and gas. What balances the scale is the price set in the market for it. For years, the global oil and gas industry has been too aggressive at pumping out oil and gas, so resources have become overly plentiful. This caused an imbalance to the supply side of the energy markets, and prices had to be lowered to get rid of it. Now added that there's a global pandemic that has severely slowed down the economy and forced people to stay at home, there are less buyers and demand has shrunk. This has caused the imbalance to be even more severe to one side, and further price decreases had to happen. There's realistically two scenarios that can happen for the prices to increase and energy markets to recover. Either the producers need to start turning off the taps so that supplies become more limited in availability, or the economy picks up and gets busy so more people want to start buying again. So going back to the worst performing Canadian ETFs this decade, our first is the Horizons Crude Oil ETF. This ETF pretty much tracks the oil price by investing in oil futures contracts. The ETF buys crude oil contracts for delivery in winter since there's good volume available to trade them, and they save money by not needing to buy contracts every month or season. They don't actually get the physical delivery of oil since they sell the futures contract in the market, and then they buy the following year's winter crude oil contract. Since crude oil is normally recorded in US dollars, this ETF hedges to the Canadian dollar so that investors can easily buy in. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. The next is the Horizons Natural Gas ETF. Like the previous ETF, this one does the same thing but with natural gas, and the portfolio buys natural gas futures contracts. Again, the ETF buys natural gas contracts for delivery in the winter since there's good volume to trade them, and they can save money by not needing to buy contracts every month or season. They don't actually get the physical delivery of gas since they sell the contract in the market, then they buy the following year's winter natural gas contract. Since natural gas is also priced in US dollars, this ETF hedges to the Canadian dollar so that investors can easily buy in. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. The third is the BMO Equal Weight Oil and Gas. This ETF invests in Canadian oil and gas companies and also includes the pipeline companies that only do distribution. The ETF tries to have a portfolio of individual holdings that are equally weighted, but due to daily fluctuations, the weights can move. These weights are rebalanced every quarter. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. The next is the BMO Equal Weight Global Base Metals ETF. This ETF invests in global base metal companies such as those in copper, lead, nickel, and zinc. These metals are commonly used in various industrial and construction industries. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. The next is the BMO Junior Oil ETF. This ETF invests in junior oil companies in North America. Companies selected are those with over 50% of their revenues conducting oil business. Inside, the investments span across various subcategories within the oil industry, and the companies are much smaller. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. BMO Junior Gas ETF. Like the previous ETF, this one invests in junior natural gas companies in North America and picks those with over 50% of their revenues in gas-related activities. Inside, the companies span across various subcategories and the holdings are much smaller companies. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. iShares S&P TSX Capped Energy ETF. This is an ETF that pretty much invests in the largest energy companies in Canada. You get various companies in oil, gas, or integrated operations. A one-time investment of $10,000 in the ETF would have declined to this amount, which is a return on investment of this rate and the corresponding annualized growth rate. Here's a summary of the ETFs I just talked about. Their management fees are on the higher end of what ETFs are normally charging. Assets under management are fairly small at under $100 million, besides the iShares ETF at the bottom, which is $600 million. Dividend yield I find is higher if there's bigger companies invested in the ETF. The 5-year return on investment is pretty consistently bad compared to the 10-year ROI, and on an annualized basis is pretty consistent. I won't be going through each ETF closure, but you'll probably have an idea of what they do by their name. The Horizons had 2, which is the Canadian dollar currency and S&P TSX 60 equal weight ETF. Vanguard had 4, Canadian short-term government bond, Asia Pacific all cap, Europe all cap, global liquidity factor. The last one just invests in companies in developed markets that are less liquid or have less volume for trading. Evolve had 3, which is the North American Gender Diversity, Marijuana Fund, and US Marijuana. iShares had 6, which was the broad commodity, China all cap, oil sands, S&P TSX global mining, Latin America, and TSX venture. And lastly, BMO had 3, which was the global banks hedged to CAD, global insurance hedged to CAD, and Schiller Select US. The last one just invests in value companies in the US, which is the same as saying they invest in companies that are more traditional, mature in age, or have sustainable businesses that aren't really growing too much. There isn't a particular trend with these Canadian ETF closures that's obvious like the ones in energy, but I find that the ETF closures should happen for mainly 2 reasons. The first is that there's not enough interest in the ETF strategy. If investors are not interested in the fund strategy, it's because there's no money to be made, or maybe it doesn't serve a good purpose, like protection, growth, or income. The second is there's just not enough assets under management to justify the management fees to operate the fund. It's why someone like BMO could shutter their entire Euro ETF product line, simply because they just weren't making enough in fees from them. To avoid being an ETFs that are at risk of closing, there are 4 aspects to check out. The first is you can check their size of assets under management. Anything under 50 million is pretty small. I would say that any ETF over 100 million is where I look for more stability. You'd be surprised that even some individual ETFs by big names like Vanguard or iShares can be pretty small. Here's Vanguard's Canadian Corporate Bond ETF. This is the ETF that owns the debts of several large Canadian corporations. This ETF has an AUM of only 44 million, and its management expense ratio is 0.26%, meaning this ETF only makes $114,000. That's barely enough to hire a management team. If you look back at our list of 7 ETFs, check out each of the AUMs. Most of them are low amounts below the $50 million threshold. The second thing you can do is to make sure that the issuer of the ETF is someone with credibility. I like big names like Vanguard and iShares, because if an issuer with less credibility sees their overall business is dying, then all their ETF products are jumping off the bridge together, no matter how good some of them may be. Usually a good issuer should have a large library of ETFs to choose from, with at least a few that have very large AUMs in the $500 million to $1 billion range. These sizes are at least putting food on the table for the management team. Simply, the larger issuers have been getting most of the pie too. Third, it doesn't matter what the ETF strategy is or what they're invested in. If it's an ETF that has a history of losing money over many years, then its AUM would just drop naturally from bad investment performance. Perhaps the ETF's AUM falls low enough to an amount where the fees earned just don't justify running the strategy. Last, see how many other ETF products are out there doing the exact same strategy, and how their performance has been against each other. This can be a simple Google search. For example, if you find that there's 10 different ETFs trying to do a Canadian dividend ETF strategy, you'll want to quickly check where your ETF ranks on performance and fees against the rest. Typically, the lower performing or more expensive ETFs will have investors selling out and buying the better ones, so this might cause the AUM to drop to a point where fees charged again are too low and the fund is better off closing. So that's all for now. If you enjoyed this video or learned something new, remember to like this video and subscribe if you haven't already. Let me know in the comments below if you've ever invested in an ETF that ended up closing down.